Angel investing can be both exhilarating and daunting. It's an opportunity to invest in innovative and potentially world-changing startups, but it also comes with a high degree of risk. Angel investors provide seed funding to startups in exchange for an equity stake in the company. These investors often bring not only financial resources, but also valuable expertise and connections to help the startup grow and succeed. With the right investment strategy, angel investing can provide significant returns, but it's important to approach it with caution and a willingness to accept the possibility of losing your investment. Overall, angel investing can be a thrilling and rewarding way to support the development of new and exciting technologies, products, and services. Here are some key factors to consider when angel investing. Risk. Angel investing is a type of investment strategy where individuals invest their own money into startup companies that are in their early stages of development. This type of investing is high risk due to the fact that startups often have a high failure rate. In fact, studies show that a large percentage of startups fail within the first few years of operation. Therefore, it is important for individuals interested in angel investing to be prepared for the possibility of losing their investment. Angel investing should be seen as a long-term investment, as it can take several years for a startup to become profitable. This means that individuals should only invest money that they can afford to lose, and not rely on it as their primary source of income. It is also important for individuals to thoroughly research the startup they are considering investing in. This includes looking at the company's business plan, financials, management team, and market opportunity. Individuals should also consider seeking the advice of experienced angel investors or industry experts before making a final decision. Despite the risks, angel investing can be a rewarding experience for individuals who are willing to take on the risk. Successful investments can result in significant returns, and investors may also have the opportunity to work closely with the startup and contribute to its growth and success. Return on investment. Angel investing has become a popular strategy for high net worth individuals to invest in promising startups. This type of investing involves providing funding and support to early-stage companies in exchange for an ownership stake. While the potential rewards can be substantial, it is important to note that this type of investing is also high risk, as startups often have a high failure rate. Angel investors are typically wealthy individuals who are looking for opportunities to invest in the next big thing. They often provide funding to startups that are not yet ready for venture capital funding or traditional bank loans. In exchange for their investment, angel investors usually receive an ownership stake in the company. The potential return on investment for angel investing can be significant, as successful startups can provide a high return on investment. However, the return on investment is highly variable and dependent on the success of the startup. Investors should be prepared to potentially lose their investment and should only invest what they can afford to lose. Overall, angel investing can be an exciting opportunity for investors to support innovative new companies and potentially reap substantial rewards. However, it is important to approach this type of investing with caution and to thoroughly research and vet any potential investments before committing funds. Due diligence. Angel investing can be a high-risk, high-reward endeavor, and conducting thorough due diligence is crucial to minimize risks and increase the chances of success. Due diligence is the process of investigating and analyzing a startup's business model, management team, financials, and market opportunity before making an investment decision. One of the key aspects of due diligence is reviewing the startup's financial statements. This includes examining the income statement, balance sheet, and cash flow statement to get a clear understanding of the company's financial health and growth prospects. It is also important to assess the company's burn rate, which is the rate at which it is using up its cash reserves, to determine how long the company can sustain its operations without additional funding. Another important aspect of due diligence is conducting market research to assess the potential demand for the startup's product or service. This involves examining market trends, analyzing the competition, and identifying the target customer base. It is also essential to meet with the company's leadership team to get a sense of their experience and vision for the company's future. Overall, conducting due diligence is critical for angel investors to make informed investment decisions and increase their chances of success. It helps identify potential risks and opportunities and ensures that the investment aligns with the investor's financial goals and risk tolerance. Equity ownership. As an angel investor, one of the key aspects of the investment process is negotiating a fair equity ownership stake in the startup. This is because equity ownership directly correlates to the level of investment and risk involved. Angel investors provide early-stage funding to startups and often have to take on a significant level of risk due to the high failure rate of startups. Therefore, it is essential to negotiate an equitable ownership stake that is reflective of the investment and risk. The negotiation process can involve assessing the startup's current valuation and financials, as well as evaluating the potential for future growth and revenue. Angel investors must also consider the startup's overall business plan and management team when determining a fair equity stake. Additionally, it is important to factor in any potential dilution of equity ownership in future rounds of funding. The negotiation process may involve working with the startup's founders and other investors to come to a mutual agreement on equity ownership. It is important to maintain clear communication and transparency throughout the negotiation process to ensure that all parties are satisfied with the final agreement. Ultimately, negotiating a fair equity ownership stake is critical for angel investors to maximize their potential return on investment and minimize risk. Time horizon. Angel investing is a long-term commitment that requires patience and a willingness to wait for a potential return on investment. Startups can take several years to achieve profitability, and even longer to exit through an initial public offering, IPO, or acquisition. Therefore, it is essential to have a long-term investment horizon and a clear understanding of the risks involved. Investors should be prepared to support the startup through multiple rounds of funding and be willing to provide additional capital if needed. It is also important to develop a strong relationship with the startup's management team and provide guidance and support as needed. Angel investors can use their expertise, network, and experience to help the startup navigate challenges and seize opportunities. Additionally, it is crucial to diversify the investment portfolio and not place all funds in one startup. By spreading investments across multiple startups, investors can reduce their risk exposure and increase their chances of success. Overall, successful angel investing requires a combination of patience, due diligence, negotiation skills, and a willingness to provide ongoing support to the startup. By taking a long-term perspective and carefully selecting investments, angel investors can potentially achieve significant returns on their investments. Patient and disciplined approach to investing, and to be prepared for a longer time horizon than other investment strategies. Portfolio diversification. Angel investing can offer potentially high returns, but it also comes with a high degree of risk. It is crucial for investors to conduct due diligence and thoroughly evaluate the startup's business model, management team, and market opportunity. Additionally, negotiating a fair equity ownership stake and having a clear understanding of the investment's long-term nature can help mitigate risk. Angel investing should not be the sole focus of an investment portfolio, as it can lead to overexposure to a single asset class. Diversification across various asset classes, such as stocks, bonds, and real estate, can help to balance potential gains and losses. Investors should also have a clear understanding of their risk tolerance and only invest what they can afford to lose. Angel investing requires a long-term commitment, as startups can take several years to become profitable or exit through an IPO or acquisition. In conclusion, angel investing can be a high-risk, high-reward investment strategy that requires careful consideration and due diligence. It is important to have a clear understanding of the risks and potential rewards before investing, and to only invest what you can afford to lose. Additionally, it is crucial to have a diversified investment portfolio that balances potential gains and losses across different asset classes. If you found this video informative, kindly give it a thumbs up and consider subscribing to the channel for more content. Thank you for watching.